Equip Suppliers Limited, Master Budget Preparation, Part A, the income statement. I'm just going to start by reading up here. The following is the balance sheet for Equip Suppliers Limited as at the 31st of December. The company supplies fitness equipment to the hotel and leisure sector. So here's the balance sheet for the 31st of December. Now, this is the closing balance sheet for the end of the year just finished. And what we're going to be doing is we're going to be doing January, February, and March into the next year. So some of the figures here will be our opening balances. Now, just moving down through the question. Up here again. The following data has been agreed by the Budget Committee for the next 4 months. The committee believes the company will experience increased demand for its products and are keen to plan for this expansion. So what we have here is the budgeted sales for the next 4 months, labor costs, and the overheads. Now, we've given additional information here. The stock is sold at a 68% gross profit margin, and management policy is to hold sufficient stock on hand to meet 50% of the sales demand for the next month. Now, we're given additional information there. Some of this we don't actually need for the income statement, but we will need it for later on. Now, if we just go down to the end here, this is what we're looking at in this particular video. We're going to prepare a budgeted trading and profit and loss account for the 3 months ending the 31st of March. So in other words, the income statement for the 3 months ending the 31st of March. The monthly forecast cash budget and the forecast balance sheet are actually in 2 additional video tutorials. Now, to do the income statement, the first thing I'm going to do is I'm going to set up a blank income statement, well, a blank trading account to start off with. And I'm going to pull this up. I'm just going to explain it to you now. So here we have the blank trading account. Down here we have the trading account, sales, less the cost of goods sold, opening stock, plus the purchases, less the closing stock. That gives us the cost of goods sold, and then that will give us the gross profit. I have a trading account here for January, for February, and for March. And then over here I'm going to have a trading account combined for the 3 months, January to March. Now the point here is that if I were to ask you to prepare a budgeted trading account for the 3 months ending the 31st of March, this little bit over here would actually be enough to satisfy that requirement. So why are we doing a trading account for January and for February and for March? The reason is we are missing key pieces of information. And the easiest way to find those 3 pieces of information is to do trading accounts for the 3 separate months. Now there are of course other ways of doing it, but I think this is one of the easiest ways of doing it. So we will start off here by filling in for the month of January the information that we already have. So let's have a look. Opening stock. Well, that's the closing stock from the 31st of December. So I'm going to go back to the balance sheet, and we can see here stock 10,200. So I'm going to use that. Go back here and I'll put that in here. 10,200. Now, I'm told that the gross profit margin is 68%. Where's that coming from? Well, we just read that there. See note number 2 here. Stock is sold at a 68% gross profit margin. That means that the gross profit will be 68% of the sales figure. So if I go back here, I'll take the sales for the month of January and multiply it by 68%, and I'll get 37,400. Now, if the gross profit is 68%, well, the cost of goods sold must be 32%. So that will give us 17,600. Or of course, it'd simply be the difference between the sales and the gross profit. Now, I have a problem here. I'm missing the closing stock and I'm missing the purchases. How am I going to find those figures? Well, let's just go back here for a second. Sorry to hear. Stock is sold at a 68% gross profit margin. I just dealt with that. And management policy is to hold sufficient stock on hand to meet 50% of the sales demand for next month. So that is telling us that the closing stock figure is to be 50% of the amount that's required for February sales. Now, the goods are sold at 32%. So therefore, that is the cost of the goods I need to meet those sales. So I'm going to get 60,500 and I'm going to multiply it by 32% to get the cost of the goods that I need to meet February sales. But then we're told you don't have half of that in hand. So if I just tidy this a little bit here, put those figures in, and then have a look at this. So the closing stock for January will be February sales by 32%, which gets the cost of the goods we need to meet February sales, and I only want to have half of that in hand. So therefore it's 60,500 by 0.32, or 32%, by 0.5 gives 9,680. So I'll put that in there. 9,680. Now, that'll be a minus figure. Now that just leaves the purchase figure. How am I going to calculate the purchase figure? Well, in fact, what you have here is a little equation. Opening stock plus something minus closing stock gives 17,600. So I could write out a little equation. I have three items in it. Opening stock, purchase, and closing stock equals the cost of goods sold, and I'm missing one of them. So if I just pull up the next slide here, here we have the opening stock plus the purchases minus the closing stock gives us the cost of goods sold. So that's 10,200, so we have that, plus the purchase, I don't know, minus 9,680, that's the figure I had there, that's 9,680, gives a minus figure, equals 17,600. Now, what I'm going to do is I'm going to leave the purchases on the left-hand side of the equation, and I bring the 10,200 over, it becomes a minus 10,200, and I bring the minus 9680 over, it becomes a plus 968. And then I just add and subtract that, and I get 17,080. So that figure, 17,080, I'm going to put in there. And that's my projected or budgeted purchase figure for January. Now if we check that out, that actually works. 10,200 plus 17,080 minus 9,680 does in fact equal to 17,600. And of course, 55,000 minus 17,600 gives us 37,400, the gross profit. So what I'm going to do is I'm just going to tidy this up a little bit, but remember these two here, because for the rest of the question, we're going to go through this a little bit quicker. But from your point of view, you can go back through this video tutorial and check on these figures. Okay, so if I tidy this up, that's what we have. Now we're going to repeat the exercise now. So let's put in the figures we have. The closing stock at the end of January becomes the opening stock beginning of February. So that's 9680. That's an 8 there. Gross profit, 68% of February sales. So the gross profit for February is 68% of February sales. That is 41,140. And the cost of goods sold, well, is the difference between those two figures there is 32% of the February sales, and that's 19,360. Now, my closing stock, this figure here. Now, if you remember the little formula we had earlier, it is going to be a function of March's sales. So March's sales, 68,063, multiplied by 0.32, or 32%. That gives the cost of the goods we need for the goods in March, but I only need half that amount, so I multiply by 0.5. Now that will give us 10,890. So that's the figure I'm going to pop in. I just wrote that out. So that is 10,890. If you're not too sure about that, you can have a look back to the January calculations. And then the purchases, that's going to be 9,680 plus purchases. I just PUR for purchases, minus the closing stock, 10,890, figure we just worked out, is equal to the cost of sales, 19,360. So therefore purchases is equal to 19,360. I bring this over the far side, it becomes a minus sign, minus 9,680. I bring the minus closing stock over, it becomes a plus figure, 10,890. And if I multiply that out, it is 20,570. And that figure is the projected or budgeted purchase figure for February. So I'll just put that in, 20,570. Now, what I'm going to do is I'm going to tidy all this up and drop the figures into February. So let's tidy that up a little bit. And then we're going to do the same for March. So I'll put in the figures I have. The opening stock is the closing stock from February. So that's 10,890. The gross profit is 68% of March's sales. Remember that the gross profit for March is 68% of March's sales, so that's 46,283. The cost of goods sold is the difference, or it's 32% of March's sales. That's 21,780. And the clothing stock is a function of April's sales. Now, we were given that information at the beginning of the question, so if I'm going to go back to the beginning of the question, and we see here, note number 1 here, budget and sales, April, 76,911. So what I can do is, I can take that figure, 76,911, go back to where I was, sorry here, went to the wrong slide there, and I can work that out. So the closing stock at the end of March, 76,911, and I want to get 32% of that, so I multiply by 0.32. When I'm using a calculator, I find it easier to put in 0.32 rather than get 32%, but you know, it's up to yourself, personal preference. And then I get half of it, divided by 2, multiplied by 0.5, and that will give me 12,306. So I can put that in there. And then I'm going to work out this figure here. The same thing as before, it'll be the opening stock plus the purchase less the closing stock equals the cost of sales. So purchases equals to the cost of sales, this figure here, minus the opening stock plus the closing stock. Now if you work that out, that figure comes to 23,196. Now what I'll do is I'll tidy that up, put it in there. Now, just to finish off the trading account, I need to do the trading account for the 3 months January to March. I have the sales figure there. That is these 3 sales figures added together. It gives the total sales. The opening stock is a point in time. The opening stock is the stock on the 1st of January. So it's that figure there. 10,200. The closing stock is the stock on the 31st of March. So that's 12,306. And the purchases for the 3 months, well, the projected purchase, are those 3 figures added together, which come to 60,846. Now I'm going to work that out. Remember, it to be minus the closing stock. So 10,200 plus the 60,846 less the 12,006 gives me 12,306, gives me 58,740. I'll take that away from the projected sales to get my projected gross profit of 124,823. So if I just tidy that up, that's what we have. So that is the budgeted trading account. Now we're not quite finished yet because we have to do the rest of the income statement, which is the profit and loss account. Now I do not need to do separate little trading accounts for separate little profit and loss accounts for January, February and March, because I have all the figures. There's nothing missing. The reason that we did these here was that we had to calculate the closing stock, but more importantly, we had to calculate the purchase figure for each month, which we will need for the cash budget. So what I'm going to do now is I'm going to drop in here the expenses that I'll need to complete my income statement. So if I pop those in here and we work this out. Now this little bit should be fairly straightforward. The labour cost, well, we're actually given that. So I just go back to the here and we see labour cost there. Now just remember it's only for the 3 months. So I'm going to get those three figures there, add them together and go back to where I was. And I'll write that in over here. 47,995. I'll go get my overheads. Now, I'm going to include the overheads separate from the depreciation. So I need to net the depreciation out of it. So if I go back to where I was here, we can see there are the overheads there. So it's those three figures there. But, let's just look at the next slide here. Note number 6. Overheads, which are paid as incurred, include depreciation of 2,500 per month, but exclude the rental charge. And we'll worry about the rental charge later. 2,500 per month, I'm going to show that separately. I mean, in a profit and loss account, depreciation is an expense, but when we come to do the cash budget or the cash flow forecast, depreciation does not go in. So it actually makes sense to show it separately here. So what I'll do is, I'll add these three together and I'll subtract from it 7,500 for the depreciation and I'll give that its own line. So back here, the overheads minus the depreciation come to 30,830 and the depreciation 2,500 per month for the 3 months, 7,500. The rent, let's have a look at that. The rent is actually on the next page, beg your pardon. So we're reading it here. Is an annual charge of 36,000 payable in 2 installments. Now, from our point of view, during the profit and loss account, it doesn't matter when it's paid. What we need to put into the profit and loss account is the amount of the expenses incurred in the period. So let's have a quick look at that. The rent, 36,000 per annum for 12 months. But we're not doing 12 months. We're only doing 3 months. So I will get 3/12 of it. Or a quarter. So if I put that in there, that comes to 9,000. Doesn't matter when it's paid, whether it's paid or not paid, it's the amount of an expense that's incurred goes into the profit and loss account. Now likewise with the loan interest is 10% on the loan, 25,000. How do I know that? Well, that's in the opening balance sheet. You can see here we have 10% fixed interest loan, 25,000. So, but it's only for 3 months, so I got 3/12 of it, and that is 625. Now, if I add all my expenses up, they come to 95,950, and then it's gross profit minus the expenses gives us the net profit of 28,873. Now what I'm going to do is I'm going to tidy this up here, and that's it. So that is the trading account and the profit and loss account In other words, this whole thing together is the income statement, and that is our budgeted, our projected income statement for the 3 months ending the 31st of March. Okay, that is the end of the projected or budgeted income statement. Thank you very much. The next video will look at part B, which would be the cash budget. Alright, thank you much, and goodbye for the moment.